Sure.
All right. I can see my target audience. Hi, Natasha. How you doing? Hey, real quick.
Good, how are you?
When it comes to tutoring, I can't help you remember with your other class. I'm supposed to. That's part of my job here. Okay.
You can.
Yes. So I'm not saying I'm an expert
Yeah.
like this class. I mean, because that I'm gonna have to actually look at the book. But yeah, I can help you with that. And when you come to tutoring, you just tell me what what subject you want to hit. We can do that. Okay.
Absolutely. No, definitely. I think this class is definitely is taking up most of my time, so it's totally fine.
Which class is taking up most of your time? This one?
This class. Mm-hmm.
Okay. Yeah. Well, where do you get into this chapter, huh?
I'm looking forward to it.
Yeah, this is the whole make or break kind of part of the course here, the next 3 or 4 chapters. So, hi, Philip. Hi, Christine is here. How you doing, Christine? Well, we have 5. It's 12:01. I'm going to wait another moment here. You made a buddy the other day, huh, Christine?
I made a what?
A buddy Saturday.
I did.
When you were here tutoring, you were talking to that other lady taking her son to the airport.
Blake.
I say that's your buddy now, right?
Yeah.
Hi, awesome. Patty. All right, we have 6 people here, and I guess we can get started. You know when the tutoring times are, Tuesday through Friday evening and Saturday afternoon. And we're going into chapter 3. Now, what we're going to do in chapter 3 is introduce us to the 2 words that are going to trouble you for a little while. And there's no other way to say it. Debit and credit. We have to understand our debits and credits like we know our own name, okay? Debits and credits. We're no longer just going to say up or down or increase, decrease. We're going to say we either debited it or credited it. And to confuse things more, debit and credit don't mean plus and minus at all, okay? And we're going to get to this in a second, all right? So let me find the screen to share, which I should have right here. 1, 2, 3, boom. Can you all see the screen now? You see it, Christine? Okay, here we go. Double entry framework. Double entry, accounting, bookkeeping. Accounting is a double entry system. It means that there have to be two accounts in every single transaction. Two different accounts in every transaction. One is a debit and one is a credit. You can have many more than that, but you must have at least one debit and one credit. Otherwise, there's no transaction, okay? So debits and credits. We're going to be talking about a T account here. A T account is really just a piece of scrap paper, but it mimics what your general ledger looks like. So let's think of this as our general ledger. Remember, we said we have accounts, we have assets, we have accounts like cash and accounts receivable, and then we have liabilities like accounts payable, notes payable, equity accounts, revenues, expenses. Think of each of these T accounts as the journal, as your, maybe not the journal, but as the book of record. It is into this T account that we're going to share the information. Debit and credit, all it means is left and right. There's no other meaning beyond that, okay? Debit left, credit right. So at least let's get that under our belt, okay? Debit on the left, credits on the right. Once we have that under our belt, we're ready to start going here, okay? Debit and credit doesn't mean more or less, doesn't mean increase, decrease. Certain accounts go up with a debit, others go up with a credit, and we just have to know which ones they are. And that's the difficult part for a little bit till you get comfortable with this. Debit, credit. The T account. DR means debit, CR means credit, huh? And you have to know your debits and credits. The T account. Okay, you're going to have one of these T accounts. This is your general ledger, remember. You're going to have one of these accounts. You can think of it as a folder, huh? You're going to have one for every single account. So here is your cash T account. Cash is on top. No numbers yet. Cash. Every T account has an increase and a decrease side. Some accounts go up on the debit side, some go up on the right side. Some go up on the left, some go down on the right. The debit side is always on the left, credit side is always on the right. Left and right, that's all what we mean by debits and credits, okay? Now, let's look at a T account in action. Wow, look at that, huh? You might recognize some of these numbers. These are the numbers from chapter 2. Remember we did all those transactions for Mitchell's bicycle shop or whatever the heck, the pizza delivery guy? Well, here are your transactions as far as they affect cash and cash only. And you could probably remember some of these transactions. He started the business with this $2,000, well, we'll just pretend. He started this business with a $2,000 check out of his own pocket. And that goes on the debit side. And then he had some more increases in cash, and then he had some decreases here. All we would like you to understand here is how to foot this thing. You add the debits, you add the credits, and the high man wins. High man wins. 3,500 minus 3,130 is a balance of $370. We all see that? Get in the habit of being clear with this. This side here gets added down. Credit side gets added down. High man wins, okay? So the balance is written on the side with the larger total. So you can kind of follow what happened with cash. Let's see, he put $2,000 into the business, then he bought some motor scooters, then he sold some stuff, he sold some pizzas, then he had a whole bunch of little expenses, and at the end of the month, his business went from $2,000 to $370. So he lost cash, but he had a very profitable business, as we remember, okay? Describe the effects of debits and credits on specific types of accounts. To debit an account means to enter it on the left. To credit an account means to enter it on the right, huh? Debits may increase or decrease the specific account. This is true for credits, okay? So we're going along here. Assets, okay. Here we go. Now there's no other way to teach this other than I can give you a mnemonic or two, and you just have to memorize it. No other way to say it. Assets have a debit balance. Assets have what's called a normal debit balance. Assets have a debit balance. That means that an asset, whatever that asset is, increases with a debit and it decreases with a credit. So if we go back to our T account here, all these debits indicate cash coming in. These are all increases to cash. These are decreases. At the end of the month, the balance was $370, and it was a debit balance, which is what you should normally see under cash. Suppose you had a credit balance of $370. That's really impossible, and it tells you something is wrong because you can't have negative cash. If you have a negative cash number at the end of the month, there's a mistake in there. Something's been posted twice, something's not been posted, or you're playing the old float game, you're floating checks, where you only have $370 at the end of the month, but you write a check anyway for $1,000, knowing, or at least hoping, you'll get the money in to cover that before the check clears, okay? Assets have a debit balance. Assets, debit balance. Assets increase on the debit side. Now, our accounting equation is assets equals liabilities plus equity. Therefore, if assets have a normal debit balance, liabilities and equity have a credit balance normally. Normally a credit balance. Now, what do we mean when we say it has a normal credit balance? The normal side means the side left or right that increases the balance. So accounts payable, for example, goes up with a credit. Notes payable goes up with a credit. Equity goes up with a credit, okay? Assets equal liabilities plus equity. Debit equal credit plus credit. I've never said that before, but that might be another way you might start memorizing them. And there's only really 5 things to memorize. It's not like you have to sit down with the Bible or something, okay? So we have assets equal liabilities plus equity plus owner's capital, same thing. Again, take a look. Capital goes up with a credit balance. A credit balance. In other words, when this guy put $2,000 into his business, he debited cash. You saw that $2,000 debit back here. That $2,000, there's your debit. Your credit would be right here, 2,000, and you would be in balance, okay? Just like liability accounts. Revenues have a credit balance. And we're just about done. Revenues have a credit balance. You have to know that. You have to know it. It's not intuitive. It's nothing that comes to mind very easily other than you kind of just memorize it and then you go from there. Like you had to memorize your social security number or something, okay? Maybe not as important as that. Revenues have a normal credit balance, meaning that is the side, debit or credit, that increases it. Credit balance increases. Well, if revenues have a credit balance, guess what? Expenses have a debit balance. If revenues have a credit balance, expenses have to have a normal debit balance. And again, I repeat, When we say an account has a normal debit balance, it means that a debit increases the balance. If we say an account has a normal credit balance, it means a credit entry will increase the balance, okay? And then there's just one more that we don't really have to worry about too much, except in these first few chapters. Drawing has a debit balance. Drawing is an equity account. We know that. And we know equity has a credit balance. Drawing, though, is an account that reduces the equity, if you remember. So it's called a contra account. We're not going to worry about that right now. But the things to remember are assets, debit balance equals liability plus equity. They have to have credit balances. We get credit when we bring in revenue. Hooray! We get credit when we bring in revenue. And the opposite of that is a debit for expenses, okay? And please forgive me, I have to tell this stupid joke. I tell every semester. There was a guy who worked in accounting for 50 years. Did you know that, Nastasia? He worked 50 years in accounting. And every day he came to work, he opened up a little desk drawer he had there. He looked at a piece of paper like a Post-it note. He would study it for about 10 seconds, put it back. He retires after 50 years. People were curious to see what he looked at. They opened it up. You know what it said on that note? Debits on the left, credits on the right. Now, I hope it doesn't take you guys 50 years to realize that debits are on the left, credits are on the right, assets have a debit balance, etc. Okay? Well, here we go. We're looking at the accounting equation again. Assets equal liabilities plus equity. And then under equity, we have the capital, meaning the amount of money that the guy put into the business. We have the revenues that also increase the business. And what decreases equity? Expenses do and drawing. So we're going to, in a moment, we're going to go into some transactions where we're going to be debiting and crediting. Just got to know your debits and credits. This is a very helpful piece of paper right here. You see where it says increase, decrease, normal balance? I would ignore two of those three columns. You only need to know one. You only need to know one. You pick the one you want to know. Increase, normal balance. Normal balance probably is the one I would recommend. Assets have a normal balance of a debit. That means the debit is the increase. We know liabilities and capital have a credit balance. Increases with a credit. Revenues have a credit balance. Expenses have a debit balance. So if you know that assets have a normal debit balance, you know the asset goes up with a debit, goes down with a credit. Okay? So you can look at this, or if you want to just memorize the increases or the decrease. This here is the whole world of debits and credits right in front of you. Does anybody like mnemonics? I think, Christine, you mentioned sometimes you don't mind hearing one. Here's one. You might want to write this down. After eating dinner, write that down. After eating dinner, then draw a line like a T account. Draw yourself a T account. On the debit side, you put after eating dinner. On the credit side, put let's read comics. Okay? After eating dinner, assets, expenses, drawing. Credit side, let's liability, revenue, capital. Some students like those kinds of mnemonics. I always did myself. So that might be another way to help you kind of remember it, okay? Now you're going to be doing your homework tonight, and you're going to be sitting there and you're going to say, I forget, this isn't that. It's just going to take a little bit of scrunching away, okay? Now we're going to use the T accounts to record transactions. No more of this plus minus cash increase stuff. No more of this going across the page horizontally. Now we're going to work with T accounts, okay? This is your general ledger. These guys represent the books of your company. And they're asking, remember what they said in chapter 2, what are the steps in analyzing what happened, what accounts are affected, how does it affect the accounting equation? I think we're pretty good with that. And I'm just going to go past this. We can come back to it if we need to. Here we go. Here's our first debit and credit transaction. Mitch Williams invested $5,000 in the business. Well, we want to identify the accounts that are affected, huh? Cash and capital. Cash is an asset. Capital is part of equity, huh? The transaction is increased. The transaction is increased. I'm sorry, let me try that again. The transaction is entered as an increase in an asset and an increase in the owner's equity. So cash goes up with a debit. Capital goes up with a credit. So let's take a look. There we go. Debit cash. 5,000 cash went up with a debit. Capital went up with a credit. Okay. Notice the letter A. A. Every time you post something to the general ledger, there needs to be some kind of identifying number. It could be a sequential number, could be a date perhaps, where it makes it easy to go in and see what you did. The auditors might come in and look at your cash and they'll say, what was this $5,000 about? And that was early. You may not remember. Oh, 5,000. Gee, I don't remember that. But if you have the A going and the A, you say, oh yeah, that's of course, that's when he started the business with the 5,000. We purchased an asset for cash. We purchased an asset for cash, 2,000. Well, we know we bought equipment. They call it delivery equipment in this business. So the cash is going to go down and the equipment's going to go down. So let's see what we have here. We're going to debit the equipment because that's what increased. And we're going to credit the cash because a credit to cash decreases the balance. All right. And there we have it. There we have it. We added a new piece of equipment, 2,000, asset increased, cash decreased. And our balance, we're still in balance with the equation. Purchase of an asset on account. On account of nobody had money, so we know it's going to be accounts payable or accounts receivable. Well, we bought the motor scooter, so I suppose we're going to have to pay for it, huh? So that's going to be accounts payable. We're going to increase accounts payable, and we're also going to increase delivery equipment. One's an asset, one's a liability. Assets have a normal debit balance. So to increase an asset, we debit it. To increase accounts payable, we credit it. And here we go again. Whoops, I'm sorry. Here we go. We debit delivery equipment for $1,800 and we credit accounts payable for $1,800. All right. Well, we're making a payment. We owe $1,800, but now we're going to pay it down. Identify the accounts that are affected. Well, as soon as you see payment, you know that's cash. So we spent cash, so that's going to decrease the cash, right? Cash is going to decrease, but so is accounts payable because we don't owe $1,800 anymore. We now owe only $1,200. Take a peek. Cash D went down by $600 with a credit, and accounts payable also went down, but it went down with a debit. Went down with a debit. Now he made some deliveries. Now we have revenues, huh? Revenues. We said revenues have a credit balance. Credit balance. We're going to read comics. Revenues have a credit balance. And he got $2,100 in cash. So cash is an asset that's going up. And delivery fees are going up as well. Well, the cash, the asset goes up with a debit, has a normal debit balance. Revenue, normal credit balance. And there she blows. He got 30, where is it? I'm sorry, $2,100 here. E, delivery fees, $2,100. Hopefully you're getting the feel for this, huh? He paid the rent. We have office rent. He paid it. He paid it with cash. Cash is an asset. Well, that asset's going down, huh? We paid the rent, and that expense is going up with a debit. So let's see what we have. I'm sorry, we're going to credit the cash, debit, rent expense. Cash, we credit cash. It brought the balance from 4,500 to 35. We debit rent expense, and now this guy is showing his first revenues and expenses. Just continue along here. Paid the phone bill. We have more expense. We paid it with cash. Cash has a normal debit balance, and so do expenses. So one expense is going up. The other one, cash, is going down. So we're going to debit phone expense. We're going to debit telephone expense. And we're going to credit cash. Credit cash. Jump in if you have any questions. If I'm going too quickly, you have any thoughts you want to express? Delivery revenues earned on account. Again, we come up with the on account and no money business. So we know it's either accounts payable or accounts receivable. Well, we made the deliveries, so someone's going to pay us, namely our customer, huh? We have good customers, they pay us. So the two accounts involved are accounts receivable, which is an asset, and the revenue delivery fees. Well, revenues are recognized when earned, we know that. So we're going to debit accounts receivable, which increases the balance, and we're going to credit delivery fees, which increases that balance. So here's your debit to accounts receivable, 2,400. And here is your credit or increase, if you will, to revenue, 2,400. Mitch bought an asset. He bought these supplies. He bought $80 worth of supplies that they're not going to use for a long time. $80, a big deal. So this is an asset. Supplies are going to go up. It's an asset. And cash is going to go down. So one asset went up and one went down. One asset went up. The other one went down. Okay. What went up? Supplies were debited, cash was credited. And we're working these balances now as we go along. Cash receipts from prior sales. Well, let's just go back up there. Accounts receivable, our customers owe us $2,400 right now. Now, somebody paid $1,900. Oh man, that's great. We got $1,900 in cash. Well, it doesn't have anything to do with revenues. We've already recorded the revenues when we sold the stuff last month. So what do we have here? We have cash increasing with a debit, and accounts receivable, which is an asset, is going to be reduced with a credit for $1,900. And there's a good look at it right there. Cash went up 19, receivables went down 1,900, huh? Just give me a little snort here. Boom. Purchase of an asset on credit, making a partial payment. Oh, good gosh, what do we have here? 3-line entry, huh? We bought a motor scooter for $1,000. We now have a motor scooter. It's $1,000. It's an asset. We paid some cash down on it, right? $300. That means we owe the balance $700. So let's get our debits and credits lined up here. We're going to debit the equipment for $1,000 to increase it, that asset. We're going to credit the asset cash to reduce that asset. And we're going to credit accounts payable to increase the liability. Okay. And here we're looking at it again. If you can't read those numbers, let me know, and make them bigger. In fact, I think I am going to make them bigger because I can't see them. Okay. Let me fix that. I don't like that. Okay. Now, he bought an insurance policy. An insurance policy is an asset. It's an asset. It's not an expense until you get coverage. So he bought this policy maybe in December, and it covers the next 8 months, January through August of the next year. So one asset is debited to increase it, prepaid insurance, and another asset is credited to reduce it, cash. Not too bad. Payment of wages. It's just another expense. And we're paying it in cash. So wage expenses obviously increase and cash obviously decreases, meaning we debit wage expense for $1,650, we credit cash for $1,650. And you can see this starting to build up now. He's got 3 expenses going. He's got some revenues. Now here we go. Here we sold some more, we delivered more pizzas. We have total delivery fees for the month of $3,500, and our customers paid us right away $900. So our customers now owe us $2,600. The $2,600 on account has to be either accounts payable or accounts receivable. Since we sold the goods, we are talking about accounts receivable. So take a pick at our journal entry here. We're going to debit cash for $900 to increase it. We're going to debit the other asset to increase accounts receivable by $26, and we're going to recognize the delivery revenues of $3,500. We recognize it as a revenue now. We don't care when we're going to get paid in terms of when to record the sale. And we're starting to build those delivery fees up. Here we go, getting toward the end, I think, huh? Remember, he withdrew $3,000. He withdrew $3,000. $3,000. Drawing is not an expense. That's not a company expense. That's not a company expense. That's the owner reducing the value of his business by taking cash out, which he or she is certainly permitted to do, right? You can do whatever you want. So Mitchell took $3,000 out. So we know we're going to credit cash to reduce cash with a credit. And even though capital normally has a credit balance, this is an outlier. This is called a contra. We're going to debit drawing for $3,000, which has the effect of reducing overall capital. Then here we are. Can you read that, Christine? Yeah? Okay. I can barely see it. Okay. All right. Let me go back. We have now completed the month's activity, and we footed all of the balances. At the end of the month, what was the balance in our assets? Assets have a debit balance, right? Normal debit balance. What do we have here? We have a balance of $470 in cash, $3,100 in receivables, etc. Hold on, let me just, oh, guys, shut up for a second. Okay, look at our balance in liabilities. It's a credit balance. Equities could have a credit balance. Revenues credit, debit for expenses, okay? Now, we're going to prepare a trial balance. And just give me 1 second, close the window. There we go. prepare a trial balance. You are seeing the trial balance for the first time, I believe. A trial balance is not a financial statement. It is a worksheet. It is what we're going to use to prepare the financial statements when we get into chapter 4 and 5 and 6. The trial balance. The trial balance is simply a list of all of your accounts, starting with your current assets, going down through expenses, with a debit column and a credit column. That's all it is. The trial balance. The only thing the trial balance does for us is determine that debits equal credits. Big deal. That's all it does. And again, I say this sincerely, you're not going to have that worry in your working life because no system will let you go out of balance, okay? So you list all the accounts and their balances. That's all you're doing. It just proves that the accounting equation is okay. It's not a formal statement or a report, and nobody looks at the trial balance once the month is over. The trial balance is a tool for the accounting department. That's all. It's used as an aid, though, in preparing financial statements. And let me show you how. Important news here. The trial balance goes in order: assets, liabilities, owner's equity, revenues, expenses. Look, in other words, it's the chart of accounts. If you look in your book, in one of the inside covers, I believe the chart of accounts is there. So that's what we're talking about. Here it is right here. Here is your first look at a trial balance. Trial balance, Mitchell Company trial balance. And where did we get all these balances? I see 470, 3,100, 80, 700. 470, 31, 80. We got them obviously from the work we did earlier. This is the source. We have revenue of, I can't read the number, 8,000, and then we have expenses. So every item on that trial balance came from the general ledger. It came from our general ledger. Cash has a normal debit balance. Look at equity. Capital or equity, same thing. Capital, 5,000 credit, that increased capital, but the 3,000 in drawing reduced it with the debit. Think of this way. The drawing account is married to the capital. The drawing account is married to the capital. Capital goes up with a credit, but its partner, its wife, takes the money out, 3,000 with the debit, okay? Trial balance. Now look what they did here. Let's pay attention to this. Color code. They color coded it for us. Oh, how nice. Take a look at the blue, the royal blue, I guess that is. You have cash, accounts receivable, supplies, prepaid insurance, and delivery equipment. Those are your assets. Those are your assets. Your accounts payable, you only have one payable, 1,900. The capital at the beginning was 5,000. Then the drawing reduced it by 3. So your capital at the end of the month, before we roll in the P&L, is $2,000. In green, you see the revenues, and in red, the expenses. Red, the expenses. I see 8,000 in revenue, right? Minus 100, minus 1,000, minus 1,100. That's what? 2,750. 8,000 minus 2,750 is 5,250. They made a profit of 5,250. That's how you use the trial balance. Keep this in mind, please. You see where it says drawing? I would suggest take a pencil and write a vertical line, horizontal line under it. Underline drawing, underline it. You know why? Because everything above that line is your balance sheet. Everything below it is your income statement. Okay? unless they give you a problem where they take the trial balance out of order, in which case I will be pretty annoyed. You're not going to get it like that on a test. I don't think Cornelia ever does it. I know I never do. There's one of the textbooks that we dismissed loved to present problems to you guys with a trial balance that was a little bit mixed up, and it caused more confusion. So take a look at your trial balance. You have the assets in blue, liabilities, then the purple equity, more purple. So now we know that the income statement is right here, 8,000 minus those three expenses. We're going to take this trial balance and look at this. Here is our income statement. Here's our income statement. Mitchell's campus delivery income statement for the month ended, which is the correct writing there. Revenue, he starts off with a generic revenue, colon, and then you list all of your different types of revenue. He happens to just have the one, delivery phase, which he indents all the way to the right. And then he lists the three expenses. That came out to $2,750. And there's that amazing profit of $5,250. This guy made like 63%. I'm just going to figure that number real quick. I'm being a little bit like Sheldon Cooper here. Hold on one second. 5,250 was his profit. I'm going to divide that by his sales number. Almost 66% he earned on his money. Not too many banks are paying 66% right now, except maybe in Argentina or someplace with crazy inflation. So our net income, how did we do it? It came right from the trial balance. Now we have to do the equity statement. And that was another one of my acronyms. Remember, BIDE. You got to bide your time, BIDE. So we're going to have a beginning capital of 5. We're going to have income less the drawing. So let's take a look at this. Mitchell Capital at June 1 was 0. Then during the month, I guess, he started the business with $5,000. The net income was $5,250. So that increases his capital, but that's partially offset by the $3,000 drawing. So the change is really to $2,250. So he ends up with an ending capital balance of $7,250. Okay. The equity statement tends to scare some students, and it really shouldn't. All it is the beginning plus income minus drawing equals the ending. And on the test, especially when you get into Accounting 230, they'll give you a multiple choice problem, and they'll say the beginning balance was 5,000, the income was 5,250, and the ending balance was 7,250. How much was the drawing? And you just have to do a little bit of arithmetic to back into that, okay? That takes us to our final financial statement, the balance sheet. And notice that we brought down the 7,250. The beginning balance was 5,000. 5,000 is what we had on the trial balance. But now we're going to close out the income statement. So the new equity number has gone from 7,250, new capital number, to 7,250. And where, sorry guys, I screwed up again. And where did they get that 5,000? Came right from here. So there's the 7,250. Where did they get the rest of the balance sheet? They just copied it. All you have to do is copy it now from the trial balance. And now we're done. So these are the financial statements that Mitchell can have somebody, he can have somebody come in. You know, this is a small business. He can hire a local CPA. He doesn't need Arthur Anderson type guns to do that. So the CPA comes in, does her due diligence, blesses the statements with an unqualified opinion. And now Mitchell can take these statements to a bank and say, look at my business here. I'm making a ton of money. I mean, if I had 3 more scooters, if you loan me $10,000 to buy 4 more scooters, I can really do well. and maybe he can grow the business into something really big, huh? That's the end of today's presentation. The end of the I see the disappointed looks on everybody. I'll go through. What do you think, Patty? Any questions?
No, not really. I already finished the work for this chapter, and so it's just kind of nice to have a review.
Oh, look at that, huh? Natasha, what do you think?
Yeah, I mean, I haven't really started, so we'll see. It's pretty overwhelming, but I think I can get through it.
Cash, we just got cash in from somebody, right? Do we debit or credit the account?
Credit.
No, you're wrong. You're wrong. And I'm
Start
trying.
it.
Yeah, you debit.
Oh, I
You're all
tried.
gonna go through this. You're all gonna go through this. If I could rattle each one of you in 2 seconds by that. It's not a fair question at this point. Lauren, you have any questions? Did Lauren take off? Hi, Bastian. How you doing?
Good. How are you?
Hey, you got any comments here?
Only one.
Yeah.
Because I've heard a couple of people talk about this before, but food seems to be really fickle as far as a business expense. Because like you showed in the example, if you make a withdrawal,
Yep.
from the owner specifically, you can't write that off as a business expense.
No, it's not.
But if you have, I don't know, an office with a few employees and you reserve an account with money for food, it would be an expense of the business, correct?
Absolutely right. That's a great question. I'm glad you asked that. Yeah, he took $3,000 out. And you're the accounting guy, Bastian, said, okay, boss, where do I code this $3,000? And he said, well, I'm going over to the hotel tonight and make a down payment on the company Christmas party. That would be a company expense. And that's
So
kind of what you're
essentially, as
saying.
long as it's in the name of the company, it is
As
an
long as
expense.
as long as it's done in the name of the company for the company's benefit. Yeah. Yeah. So maybe they have a Christmas party every year. Maybe that 3,000 was he's taking half a dozen potential customers out to dinner at a fancy restaurant. That's a classic expense. That would be entertainment expense. You know, maybe that $3,000 buys him a plane ticket to go to a trade show. That would be expense. But when you just take the money out for your own personal use, that's drawing. Okay?
Yeah, thank you.
Good question. Hey, Christine, we'll end with you. Any questions here?
No, all I could say is that I've done this for a long time and debits and credits are my Achilles heel. But you've made it really actually very helpful. I'm after all these years starting to understand it more.
Yeah, well, you're doing them automatically in your system, right? Without needing to. Really,
yeah, I mean, QuickBooks takes care of all that. So I would do like if one didn't work on a journal entry, I'd just switch it.
You eventually find the answer. Huh?
Yeah.
All right. Well, I make a motion. We call an adjournment to today's class. Do you second that, Natasha? Natasha says we can leave. Thank you, Natasha. Everybody. See you tomorrow night. Bye bye.
Thank
All right,
you.
have a
See you
good one.
tomorrow. Thank you.
Bye bye.
See ya.